Welcome to Kuvera Insights, where we speak with experts from across the spectrum to glean insights on better financial management. Very excited about the two guests we have today, as both of them have over 25 years of experience in financial services and from a very different vantage point for each of them. Introducing first Prathit, who has led Tata Asset Management Company as CEO and MD since 2018. He has been in financial services for 25 years, like I mentioned, and prior to Tata, he has had senior management roles at both ICICI Bank and Citibank in wealth management, in retail banking, and also in retail liability products. So welcome, Prathit. We also have KS Badri Narayanan with us. He's the markets editor for Hindu Business Line. And he has been also tracking markets since 1995. And it so happens that his special interest is regulators. So this is going to be a very interesting conversation. We have a platform, we have an AMC, and we have someone whose specialty is regulators. So let's get down to it and let's get started. Starting with you, Prathit, right? So what are the risks and opportunities that you see this year and next? And how are the different market participants, analyzing that risk? Like, what do you see in the lump sum flows, in the SIP flows, or how do you see the FII, DII flows, and what are you thinking within Tata AMC on this year and next year?
Sure. I think while the usual context is that many people ask why is it different this time. I think one big reason why we're looking at a situation which is significantly different this time is because the impact this time has been on human lives. And it's my belief that anytime human lives are impacted on the scale that they've been impacted this time around, the impact will often be very, very profound. And which is why I think when you ask this question that what are the risks and opportunities that we see for the next, say, 12 or 18 months, I think we need to bear in mind the context that this time around, since, like I said, the impact is on human life, the second order and the third order effects of what is happening and what we are living through right now are going to be something which we'll have to evaluate as they happen. There is no script as to looking back and seeing what's happened in the past, because in forget our living history, I can't recall something having experience like this for over a century now, where things just shut down. And to that extent, I'm saying when you say what are the risks and opportunities, I would like to look at it as glass half full, really, and see what could be the potential opportunities. And I think the way we're approaching it as a fund house is we've of course looked at companies where there is the obvious impact which is going to be visible on companies in terms of earnings and in terms of the businesses that they're in, and we've looked at recalibrating our portfolio to look at companies which potentially could be having a lesser impact. I don't think we're going to look at a situation where there is no impact, and which is why I said there's going to be a lot of second and a third order impact that one has to evaluate. But I think that's how we are looking at positioning our portfolios. And in terms of an opportunity, I think it's important to be treading light at this point of time. So while one may have recalibrated the portfolio, I think you have to be nimble. You have to be nimble. I don't think taking focused bets is really the time to manage portfolios at this point of time. That time will come, but at this point of time, our approach is, like I said, recalibrate and be nimble in order to look at opportunities for the future. I think the second question which you asked was with respect to flows. And I think that's really pertinent because if you really look at last year, for example, in equities particularly, we had close to 58,000 crores of flows in the industry. And if you just look at the monthly SIP number that the industry gets, that number last year was a little over 8,000 crores, which means a simple math will tell you that we should have got close to 1 lakh crores just by way of SIPs in the market last year. But on a net basis, the industry actually got just a little less than 60,000 crores. So while there have been several months where we've seen record flows, including the recent month of February, I think the issue is that at a overall level, we're still seeing the market being supported by SIP flows, and which is actually great because, I think the regular investor, despite what is happening in equities, is still continuing to stay invested. And I think that realization that you will make money in equities over a period of time has definitely a great acceptance amongst Indian investors now. I think just on the point of risk, though, from an investor point of view, I think the real risk is the whole recalibration that we are witnessing right now in terms of the fixed income side of portfolios. I just think, as the journey that investors have seen over the last many years in equities is something which, the Indian mindset has still not witnessed with respect to fixed income. And I think
That's a very
the
fair point.
realization that the fixed income business carries risks. When an investor is investing in fixed income, there is inherently risk in it, is something which I think is just sort of dawning on investors at this point of time. And I think that's the short-term pain that everybody will have to live through.
Fair enough. Fair enough. Very, very good points. Especially, around the fixed income piece, and kind of suddenly this realization that credit risk can manifest itself, and usually manifest itself at times when the broader economy is also not doing very well. What we call pro-cyclical. It's as pro-cyclical a risk as equity risk is.
That's
So
right.
especially kind of, if you come in with this expectation that, hey, the debt part of my portfolio, or if this is your prior, that the credit risk part of my portfolio is going to be a kind of like be not so correlated to the equity part of my portfolio, which in general markets might be true, but when we get to extreme pain, the correlation gets to 1, and that's a lesson that kind of, I think that's a lesson I would say, Badri, that investors learn pretty much in every downturn, right?
To add to what Prathit said, this time
Right.
I see a lot of retail investors' mind changes there. In 2000 August, if I remember, one of my aunt, she told me, I will give you 10,000 and give me 25,000 in 1 month when the boom was running.
Right.
And then I thought that was
Right.
the market peak. Now I
Right.
see a lot of my friends who invest now say, they continue to invest in the market. They say, tell me very good fund or very good stocks I want to invest. Their level of return has been moderated. They say, if I get 10 to 12% over a long period, that is fine. That kind of moderation to a lot of retail investors have come, which is very good sign. And a lot of people have learned lesson given the direction of interest rates going down. This is one lesson I saw, and that is what reflecting on SIP also. A lot of people wishing to pumping more money through SIP, they are not stopping, despite uncertainty happening across the world.
So I think for the long-term investor, that's definitely the story, right? I mean, at least someone who's lived through 2008 or 2011, they've seen the markets bounce back. How do you educate? And I think Prathit and Badri, you can both take a shot at this. How do you educate the new investor? There has been this boom, right? Last couple of years, a lot of people have done first-time KYCs, new folios. A lot of those numbers have improved. How do you manage that investor set that maybe has theoretically seen the market history but has not lived through it, and living through it is very different than seeing it on a chart. Seeing it on a chart, it's always an opportunity, but when you're living through it, then it's the real risk.
So Gaurav, I think I would like to address it in 2 parts. When you talk of a first time investor, in my mind, I always look at a first time investor who's coming in from platforms such as yours, for example. And I think you will see a lot of folks in the age bracket of 25, 30, first jobbers, or early investors in that sense. And and then you have the other first time investors who are who've been in who are 45, 50-year-old, who've been around and who are just starting to sort of invest. In my mind, I think the folks who come in, which is in the latter category, the 45, 50-year-old investor and so on, typically is coming in through in my experience, a assisted model, which means, the traditional models of distributors, be it a bank or be it a IFA and so on. And to that extent, there is hand-holding and the ability to sort of ride out these volatilities
Right.
exists. And I often wonder, and in fact, as I answer this, I'm going to sort of ask you this,
Sure. Sure.
is the about the first-time investors who are really the 25 and 30-year-old folks,
Right.
and who invest largely in the digital, because these are digitally natives, and you know them better. I keep wondering that when a situation like this happens to these first time investors, how are they going to deal with this situation? Who do they refer to? And how do platforms then manage these investors? Because I think this part of volatility, the handholding that has to happen at this time is very, very critical. You invest money and you get your money back in a fixed income product, or equities give you 8-10% is great. Nobody cares, right? Everybody is happy with it. But what
Right.
happens when your media sort of turned on the heat with respect to the industry and with respect to investment options, and all you see is negativity? How do platforms like yours, because that's the other part of the segment which I think is the growing opportunity for everybody, but I think platforms such as yours, I think, are very, very critical to this segment, and that will determine how we do in the future.
See, fair enough. It's an interesting question, and we have both the investor set, right? So we do get a lot of first time investors of 40 to 45. We do their
I'm
KYC.
sure.
Their expectations are also quite different, and I think their expectations are more tempered. They have seen, even if they were not invested at that time, but they saw the crash of 2008. They were there, even though their money was not invested, right? So the 25 to 30-year-old, I think it boils down to two parts, right? So, and there's a lot of literature around both of them. So one is, of course, financial literacy changes how people manage their wealth, right? Like, are they investing for a goal? Are they investing for a purpose, versus are they just investing to maximize returns? That framing makes a huge difference. So we try and kind of create a construct where this money is for a purpose, and this is not just a game where okay, you're down and then you're like, oh my god, this is bad. And the second part is that we educate them again, and we educate them in good times also. Not just, it's not a factor of just saying that, hey, you know what, now the market's down, we're going to come and educate you. When actually there's enough data that shows that when the markets are down, then the opportunity to educate is already lost. The education, the whole education around long-term SIP, the whole education around goal-based investing, the whole education around, hey, this is what happened in 2008, this is why 2008 was a good opportunity, the whole conversation in words that they can understand, right? Making simplistic statements instead of kind of making very complicated statements, breaking down the argument into very simple parts, right? Like something as simple as, someone recently asked us, right, like, is this a is it a good time to be aggressive in a bear market, right? Now, if you get into the details, if you get into the intricacies, it becomes a very difficult argument. But a simplistic response is, being aggressive in a bear market always beats being aggressive in a bull market, and that's always true, right? So by kind of reminding people that, hey, remember at 12,000 you were really bullish, and you were looking to step up your SIP. So unless today your cash flows have dramatically changed, in which case we understand that you have to stop your SIP, and we also would want you to stop your SIP, right? If your cash flows have changed, please don't continue your SIP. But otherwise, if 12,000 is a good level, then this is a better level. So I think that education has to be continuous, and ongoing. As digital platforms, one advantage that we have, and I think some of it is kind of not written so much about or not researched so much about, is that one is that we can maintain a level of conversations which is much higher than in an assisted model. It sounds a bit odd, but we can send a piece of communication, or we can send some advice at the right time every week through email, through SMS, through kind of push notification. Then we know it will be received and it will be read, and if there are additional questions, they're going to come back to us. Second is, I think there is some growing evidence already that shows this, that people do tend to trust robo-advisors for the simple reason that whatever our advice is, right, whether it is about goal planning, whether it is about rebalancing your debt equity portfolio, whether it is about switching from regular to direct, or any of the kind of advisory pieces we have about long-term capital gains planning, it's all done in a public space. So it gets vetted very quickly. We are not giving advice in a closed room where no one else can cross check it. Our advice is going out to tens of thousands of people at the same time, and some of them are super smart investors. These guys know as much personal finance as anyone that I know, right? I mean, we are very actively part of investment groups and Reddit investment groups on Facebook. These guys know their stuff. So that's how we kind of deal with it. We think of it as a continuous process. People will come to us and they'll say that, what, can you take a look at our portfolio? But we rarely have situations where someone comes and says, hey, you know what, I want to give advice to a larger set of people. So I don't think people contextualize it in that sense. If you know what I'm saying, Prathit, I don't know if you want to add there something.
Yeah.
We've never had this situation,
so
I'm thinking deep here.
So I think in the sense, of course, we manage money from an investor point of view, but I think the product creation really is more top-down or AMC-led in that sense. Though, given that historically this business has always been led by partnerships with platforms or with the traditional channels and so on, I think there's a great deal of feedback which we aggregate from partners. And to that extent, I think product creation in order to fulfill that need of the investor does happen when you basis the opportunity, you try to create relevant products. So that does happen. I think some part of that is coming from the feedback which we get. But honestly, it's not very, very investor-led because we're largely B2B. So in our case, the investor feedback has to come from partners really. And there is evidence of the industry doing that.
Sir, I mean, do you see any redemption pressure now during this slowdown?
Actually, no. Actually, the month of at Tata's in particular, or the industry, Badri?
Yes, Tata Group as well as some mutual fund.
So, industry as a whole, as you would know, had a record March in a flow sense. So. Evidence tells you that it was a very, very good month in that sense. But at Tata's as well, we had inflows. So we had a positive month as well. And in this month in particular, I think over the past week or so, I think there has been clearly, because of what's been happening in the ecosystem with respect to fixed income, I think the industry is witnessing pressure. Which is really, like I said, more on the fixed income side. Fortunately for us, in particular at Tata's, we've not been present in the credit space. And since we were not present in the credit space, we've sort of not witnessed what we are seeing the industry witnessing at this point of time. So Badri, I wanted to ask you this, that since you've covered the markets for a fairly long period of time and we've seen various cycles, and you've obviously looked at the industry closely and you've looked at the investors pretty closely from a psyche perspective. What's been your experience of, how have investors evolved in their mindset sense, if you were to sort of opine on that?
Once the market is down, I mean, your life is not yet there. Those who have courage, I saw a lot of investors who withstood Ketan Parekh scam. They are rewarded very well. I mean, they've grown up like big investors, HNIs. Whereas those people, I mean, those miss the bus, I mean, they are always behind the curve and they feel that, I mean, we miss the bus. Most of the people are not investing. Those don't have confidence in the market.
And I think, sorry.
People prefer to book profit as well as cut loss. Earlier, they don't cut loss. They keep on accumulating, filing. That changes. Yeah. That's a welcome change.
Yeah. And I think thanks to, at least in my mind, a lot has to do with this ongoing education by various platforms. And, the point which Gaurav, you made earlier about how it is important to continuously engage with investors and keep on bringing them up the curve, because I think if I were to relate Badri's experience of, because I remember the time that he's referring to where people used to invest and money used to practically double in such a short period of time that I think people used to get into the market thinking that, money is going to multiply overnight. And now I think I think he makes a great point that now I think the expectations are far more sort of, never say realistic, but I think far more moderated, that it's not possible to multiply money every now and then. So I think I think he makes a great point. And I think to that extent, I would credit a lot to, say, platforms or various partners that we have in terms of how investors have been educated over these last 2 decades or so.
See, coming to kind of the ecosystem play, right? So, Badri, when you're in the middle of this crisis, right? Like, what are some of the things that you would want the regulator to do? I mean, you've been tracking regulators for a long time. I think SEBI is a fantastic market regulator, but how do they, what's happening in the credit space, or the kind of the place we are in the entire journey, where things are a bit on the tip of a needle, right? It can go anywhere. So how does the regulator kind of manage this?
They should come or talk to people. Nothing is happening. Come on. I mean, we are taking steps. We are assuring you. SEBI is doing fantastic job. I mean, no systemic risk despite the crude pricing falling negative. I mean, the settlement happened very smoothly. So all these things happen. But I want them to be more open. I mean, like RBI coming every now and then addressing people. Like that, SEBI should also giving some kind of comfort to investors.
So my experience with the regulators actually has been very, very good, in the sense that while they may not have been sort of visible on the screen, so to say, but to give credit to our regulators, I think they've stayed in step with the requirements of the market. And I say it for all the regulators. I think they've been just exceptional with how they've sort of managed the need of the hour at all points of time at least over the last decade or so. I've seen them to be extremely in line with the need of the market. So I personally think the regulators have been very, very in step.
On that note, let's ask you a personal question. How do you guys invest yourself? What's your investing mantra? Long-term investors, short-term investors? There are no right answers. Just your personal style of investing.
Whatever. Before Arshad Mehta, at that time I was not writing much. So I invest a lot of companies which even I don't know, even the company management may not have what they are doing. I invested, I made money. Finally, I lost money also. That was the lesson I learned from that episode. And I thank Arshad Mehta, because of him only, this beautiful world of equity I came to know. Otherwise, I would not have. He single-handedly generated a lot of interest among retail investors. Without social media, you spread awareness on equity, though on the negative side.
Initially on the positive side, then on the negative side. But it's a point that not a lot of people make or articulate, in that sense, that he was also responsible to evangelize equity investing in India in his earlier run, right? So, and Prathit, how about you?
Well, I have always been an equity investor right from college days. I think Badri mentioned Arshad Mehta repeatedly, and my journey of investing started way back in '91, just a little prior to Arshad Mehta happening. I remember investing in stocks by me and a couple of guys pooling money together, actually. And I even remember the first stock I bought, which used to be SCICI. It used to be a industrial credit company for financing shipping, which was promoted by a couple of institutions like ICICI and so on. And it then merged with ICICI, you're right. So I think that was the first stock I bought. I still remember I made money off it. After that, like Badri said, I have lost money, made money, but I have always been an equity investor. And I personally think that's the only way you will sort of make returns which will help you sort of make a meaningful, decent post-inflation beating return really over a sustained period of time. And I have lived with that asset class as a chosen asset class. Of course, now I have restrictions on what equities, direct equities one can buy and so on, but that's a separate conversation. But as an asset class, I think equities is what I I personally invest.
Mine was
sorry,
My first investment on stock is Plenty Valley Tea.
Oh, is it? Okay.
I don't know whether the company exists, but it was quoting 12 rupees and it went to 35 or something within 4 days.
I'm actually amazed you guys remember. I just graduated and I'd gotten a job offer to start working in the US. But it was 6 months. I had to wait 6 months before I could fly out, right? Because of the H-1B visa and all those the time it takes. So I borrowed some money from my dad and I went to a broker. I set up an account and I don't remember the first stock. I'm actually amazed you guys remember the first. This is like
really?
2001, and I think I had borrowed some 25,000 rupees. I think I returned 5,000 rupees to him. That was my first kind of entry into investing, and it was 2001. Everything was crashing. So no stories where stocks double in 2 days. My first interaction of the market is, oh my god, it's a crash everywhere. Like whatever you buy goes down, right? And it's a very different starting point, but it still somehow stuck with me. So I stuck with investing in the US, and then when I was working, I had my monthly investment plans and all that, and I kept on doing that. And eventually that realization comes. I think sometimes it takes a bit of time, but eventually that realization comes that this is the simplest path to create wealth that otherwise would have been very hard for most people. So, but still amazed that you remember your first stock. So that's pretty. That's a neat story. Yeah. So there you have it, friends. That was Prathit from Tata IMC. He's the MD and CEO of Tata Asset Management Company, and Badri from the Hindu Business Line. So as Prathit said, it's not the time to be taking a lot of risks. So stay nimble. It is a human tragedy. It's something that's not happened for over a century. So it's okay sometimes to not take a lot of risk, and that's fine. But stay nimble and watch out for the opportunities as they come. Again, another wonderful episode. It was very fun talking to both Prathit and Badri. And hope to see you guys again in the next episode of Kuvera Insights. Thank you. Bye.